Hi, Bill Bodner here, Mortgage Market Guide. Thanks for tuning in to our MMG weekly recap. So, as we've been saying over the last couple of weeks, January is typically a very volatile month, especially for interest rates. And while we expected volatility, we didn't even expect this much. It's been an incredible week, and we watched Fannie Mae and Freddie Mac reporting interest rates hitting their highest level since pretty much pre-pandemic. Mortgage-backed securities losing a lot of ground. You can see here on a Thursday, we're down 22 basis points. 10-year note is ticking up the yield to what we consider at Mortgage Market Guide here, a line in the sand at 175. So you got to watch that level very carefully. What we're thinking about at Mortgage Market Guide and what we're writing to our in our weekly newsletter is this year, the way it's starting, we have a new, very surprisingly so, hawkish Fed. They're talking a big game as it relates to hiking rates, and where the market really had a struggle was chatter within the Fed minutes suggesting that they want to get into balance sheet reduction, meaning becoming potentially an outright seller of bonds. And so when you think about what has transpired over the last couple of years, the Fed is winding down their bond buying right now, where by mid-March they'll stop buying mortgage-backed securities and treasuries, and we'll have amassed about a balance sheet of about $9 trillion. So you think about the Fed over the last couple of years being a tailwind for interest rates, they are now going to be a headwind for interest rates. So I guess the question would be for your clients, well, what does that mean? And so back in 2018, the Fed hiked rates 4 times, and really the only time in history we're able to, in a small degree, reduce the balance sheet a little bit. Those are very different economic times, but that's what happened. And in that time where the Fed hiked rates 4 times and the Fed did reduce the balance sheet a bit, mortgage rates shot up a full percent in 2018. So if you want a historical perspective and something to share with your clients, that's what we're looking at. Now, we're not saying that's going to happen, but we have to watch the incoming data and be real plugged in. Obviously, next week's inflation numbers go a long way to that. And of course, the labor market data, how maximum employment looks. So that's what we're thinking about heading into this, the remainder of this month. But for right now, you got to watch 175 and a 10-year note and be sharing with clients and your partners that we now have a hawkish Fed, and that is a very different, absolutely a polar opposite of where we were in January of 2021. So hope this finds you well. Have a great weekend. Be safe, and we'll talk to you soon. Bye for now.